Hello, everyone, and welcome to our webinar on demystifying M&A, what every business owner should know. Before we begin, a couple of quick housekeeping items. You will receive a copy of the recording of this session and the slide deck in your email after the session has ended. If you have any questions, please submit it in the Q&A box and we'll answer them at the end of the session. And finally, please do feel free to complete the feedback survey, which you'll receive after this webinar with any comments or feedback that you may have. By viewing this webinar, you are eligible to receive a complimentary consultation with the lawyers at LegalVision to discuss how we can help your business. To claim your complimentary consultation, leave your contact details in the survey at the end of this webinar or contact us via our website. So today we will be discussing M&A and breaking the topic down into the following headline points, starting with the M&A landscape first of all, before going into how you can get ready as a business for a deal or M&A transaction. We will also touch on valuations and deal structuring before delving into the due diligence process and risk allocation. And then finally, we will touch on the completion process and any integration matters before finishing off with a Q&A session at the end. So starting with an introduction and the question, what actually is M&A? In a nutshell, M&A includes the buying and selling of businesses or assets. It can also involve merging companies and can extend to investing in businesses. So understanding M&A matters essential for any business owner, even if you're looking to sell your property, your business in the immediate future. If you do have a long-term plan, whether that's a succession to scale up or to exit or have a clean exit later down the line, it's essential to start future-proofing your company, your business now, so that you are ready later down the line. We've set out on this slide some common misconceptions regarding M&A. One being that M&A is only for big companies. At LegalVision, we work with a variety of businesses, including startups, as well as well-established businesses. And M&A can apply to any kind of business, regardless of the size, in our experience. And the type of transaction will be tailored to what your business looks like and its size and needs. The second myth that I've got on the slide is it's all about valuation. This isn't necessarily the case. There's more to an M&A transaction beyond the valuation, the price or value of the entity. For example, who are you selling to? What type of buyer are you interacting with? And what type of exit do you want? And finally, lawyers and accountants handle everything. Whilst your legal advisors will do the majority and handle the majority of the process, lawyers in particular will handle the legal side, and your accountants and tax advisors may have input there as well. It does still require input of the founders and other advisors and key individuals in your business. What the transaction looks like will vary from business to business. So a key point to note is that being prepared in the interim will help you long term, and having a good idea of what it looks like to be exit ready sooner rather than later will help you in the long term. And understanding what that process looks like will help also. So it is unlikely in our experience that a deal would collapse purely because of a valuation. It's usually because the business either just isn't ready or expectations of the parties are aligned. So maybe the business wasn't prepared from a due diligence perspective or a financial or tax perspective, or perhaps there could be some structural issues. The shareholders, for example, aren't aligned on what they want, or for some specific issues such as regulatory points, which a business may need to consider. That can all those points can contribute to why a deal might collapse, not just the valuation. So there's a number of factors to consider and prepare for aside from the valuation alone. And we'll touch on some of those in more detail, starting with the M&A landscape. The The market does tend to shift, and we've seen huge shifts during events such as the COVID pandemic. Lots of distressed companies who needed financial assistance came out of the pandemic, and they needed that assistance quite quickly. We did also see dips in the types of transactions, less of the larger ones, perhaps more of the smaller ones, as buyers and private equity investors were all a bit nervous during that period of time. But as of 2025, the M&A market is still very active, and we're seeing consolidation across professional services and specific sectors, such as in healthcare, tech, and construction. It's therefore important to understand the market your business operates in and what the activity levels are like. One key consideration is what types of buyers are out there. Now, typical types of buyers that we see in the M&A field include strategic buyers, and those are buyers who are typically more experienced in the M&A field and can often seek to do bolt-on transactions where they're adding to companies in their existing portfolios. We can also see private equity and financial sponsors acting in the M&A market. Private equity buyers tend to use funds to invest into companies with an exit strategy in mind, and they're usually looking for growth and high returns in their transactions. And then thirdly, we've listed here management buyouts. These sorts of transactions involve key individuals or employees of businesses who buy out the company from the shareholders or founders. For those sorts of transactions, we find it's key to use succession tools for founders and requires careful planning. So there are all kinds of different buyers and different M&A transactions. Which one is suited for you and your business will depend on what it is you want to achieve. Likewise, the way that the transaction is structured will depend on what you want to achieve as well. And the common transaction types that we tend to see include share sales, where the entire issued share capital of an entity is sold to a buyer together with everything that entity owns. Or also we see quite a lot of asset or business sales where certain aspects or certain assets of the business are sold as opposed to the entire issued share capital. We also see partial exits or recapitalizations. So instead of a full clean exit where everything is sold and handed over to a buyer, you might see a partial exit or structures where the management team will stay on for a period of time. Ultimately, the point here would be to consider what's best for your business and your long-term plans, and you should be comfortable with the structure you opt for and what in order for it to help you maximize the value of your business and help you achieve what you need. So looking at some structural trends, some of the trends that we're seeing currently include structural shifts, such as the rise of earnouts and deferred consideration. Earnouts tend to be included on transactions where buyers want to incentivize the management team or shareholders over a period of time and link the purchase price to the performance of the business. Likewise, we're also seeing vendor finance in tight capital markets and the use of deferred consideration mechanics. The way the purchase price is going to be structured depends on the business in question and its performance, the projections, and the type of buyer that you're dealing with. We're also seeing a shift in regulatory considerations. Here in the UK, the introduction of the National Security and Investment Act 2021 introduced foreign investment screening for buyers outside of the UK or investors outside of the UK. There is a growing focus on foreign buyers and the sector concentration across industries, and therefore consequently some more scrutiny and hurdles to jump through during the transaction process to make sure you are complying with these regulatory requirements. Depending on what sector your business operates, there may also be some sector-specific regulators. For example, the Financial Conduct Authority for Financial Services and Ofsted or Department of Education if you're working in the education sector. Likewise, if you're in tech or AI, there may be some specific requirements there as well. So it's worth noting that deals today are less about just the price tag and the value of the business, but more about the strategic fit and the certainty of completion from a buyer's perspective. And it's worth planning ahead and considering those points in order to get deal ready. So with all that in mind, how should a business get deal ready? Preparation is the value driver here. Where there is a preparation gap, it can be an issue. And most businesses start preparing only once they're approached. And that can sometimes be too late, or it can have an impact on the value of the business. So it's essential to start sooner rather than later to help you reap your rewards, especially as a founder. So the key work streams in order to help you get deal ready are financial readiness, legal, and operational readiness. So financial readiness, what we mean when we say that is looking at the finances of the business, your financial statements, your verified EBITDA, your consolidated working capital. Having all that in order and clean will help the due diligence process from a financial perspective, which is usually the first thing a prospective buyer will look at during a due diligence process. You should also factor in any tax or accounting issues and making sure that you're liaising with your advisors to make sure your documentation and statements are all clean. What do we mean when we say legal readiness? Here we're looking at key contracts, whether that's customers, suppliers, or maybe you have employee or contractor arrangements. Do you have contracts in place for all of those key third parties or employees? If not, that might be something that raises a red flag later down the line. If you do have contracts in place, what have those contracts got change of control provisions within them? Will you be able to transfer those contracts to a potential buyer later down the line, or will you need to obtain consent before doing so? We've also listed here IP ownership. To the extent that your business owns any intellectual property, has it been registered in the name of the company? Where you have individuals or employees in the business who have created intellectual property, has it been clearly documented that the company and business owns that intellectual property? And finally, operational readiness. Here we're looking at, are you as a business looking into each of your key persons? Have they been risk managed? Does the business depend on particular clients? For example, if you have an arrangement in place with one key client, does the business depend on that one client? What happens if that client decides to stop engaging the business? How does the business look from a brand and IP perspective? Is everything registered and documented? If not, that could be a red flag later down the line, particularly if the branding and intellectual property aspects are key to the business. So these are all points that you should be considering now before preparing for an exit, and helping the business get to a stage where you are ready in all fields. So in order for you to get ready in those sectors, we think it's worth considering and reviewing the following points within your business. So one, corporate structure. Is your corporate structure clean? Sometimes we come across businesses where you have a single business entity, it's not tied to a group, and it's quite straightforward. But in other cases, we can see businesses that form part of a larger group, and in some cases where there are international connections with entities overseas. If you do have those sorts of complicated group structures, it's worth considering whether everything structurally has been done correctly, liaising with your accountants and tax advisors to make sure it has been set up in a tax efficient way so that you're not being hit with a huge tax bill at the end of your transaction. And if you are planning on restructuring your business or your group, making sure you're speaking to your legal advisors to make sure it's all done correctly and prevent any issues later down the line. Number two, contract assignability. As we touched on the previous slide, if you have key contracts in place, can they be assigned? If your business is relying on some very key contracts in order to keep running, the buyer is going to want to make sure they can continue under those contracts. So checking that those contracts are assignable is key. Do they have any change of control provisions which require consent? And to the extent that they're coming up to renewal, are you in a position to agree new terms and enter into a new contract which the buyer can take over? Point three, financial clarity. Is there clarity on debt, leases, and related party loans to the extent that the business has any debt or property which is subject to a lease, or any loans in place with banks or third-party providers? Have they all been documented correctly? Is there any security in place which perhaps needs to be released in order for the buyer to acquire the business? And to the extent that you need any consents or authorization to proceed with the transaction, it's worth having a think about all of those in advance, because they can, on occasion, cause delays to the deal. So in order to help speed it up, both in terms of a valuation perspective as well as completion of a transaction, it's worth having all your ducks in a row and understanding what is required under all your arrangements for the business. How early you collaborate with your advisors is quite important. The sooner you do it, the more you'll speed up the process. We tend to find that businesses that spend 3 to 6 months on a pre-sale cleanup often achieve a higher multiple on their EBITDA valuations. And I've put here a 1 to 2 times the multiple uplift than if you didn't do any pre-sale cleanup. And on that note, when it comes to figuring out the purchase price, that is the value of the business, we often get asked how to go about doing this. Now, the key thing here is there's no one size fits all, and every business will look different. But how the price is calculated, we stated it's no real science. It's usually a negotiation anchored on multiples of normalized EBITDA, which is earnings before interest, tax, depreciation, and amortization. An accountant or an M&A advisor can usually assist with this calculation for your specific business. And typically, the EBITDA figure will then be multiplied by a multiple. For example, the purchase price might be 3 times the EBITDA. There can be factors that influence what that multiple is. For example, what are the growth rates for the business? What are the margins, the management depth, customer stickiness, and reoccurring revenue? They're all factors that can be considered and impact the multiple. Not all buyers will follow this mechanic, and they may just offer you a price based on their own due diligence. For example, you may be approached and say a buyer may just offer you 5 million for your business, but others may say, we want to look at your financial statements and calculate it based on the EBITDA figures. Once the valuation has been confirmed and the deal structure comes into play, and it all depends, what that structure looks like depends on the type of buyer that you're dealing with and their strategy. So the typical types of deal structures that we see include cash on completion, which is usually a clean exit, and usually preferred where there will be a full exit from the business. The founders or shareholders who are exiting don't want to continue on in the business in a management role and will be exiting. We also have deferred consideration, or earnouts, which become quite popular in recent years, and they tend to be tied to future performance of the business. So how much the shareholders will actually receive will depend on how the business performs over a set agreed period of time. Earnouts can be used as a way to incentivize shareholders or key management team who remain in the business post completion, as they are likely to continue operating the business and hitting those projections and performing well if it's linked to the final figures that they will walk away with. And third, we've listed here vendor finance. It's another type of deal structure that we come across, and involves rollover equity, bridging value gaps between parties or companies. And linking into that, we often get asked about what the concept of debt-free, cash-free, and normalized working capital means. In effect, it means that on completion of a transaction, the incoming buyer will want there to be enough working capital left in the business in order for them to continue operating post-completion without any issues. And that is something, the working capital will be factored into the calculation and the contracts of the transaction. There may also be some post-completion adjustments, depending on how you structure the transaction. For example, there may be a headline price which is agreed based on estimate numbers, and then a final figure will be the actual working capital will be calculated at the point when those numbers for the financial year are received as part of the accounting documentation. So interaction with tax planning is something that's really important to consider. There may be capital gains implications or other implications as a result of your transaction. If you've got an asset sale, you may be called back the business asset disposal relief, maybe inheritance tax considerations or stamp duty on asset acquisitions. And of course, the timings of payments may have an implication on tax as well. So we do say it's really important to get tax advice early, even on initial stage of a startup. We do say you should be considering how you structure your business so that it's most tax effective for you, because nobody wants to lose a big chunk of their purchase price to the tax office because you didn't structure it correctly. So it's worth engaging with your tax advisors as soon as possible. We tend to find that founders who understand a structure can better shape their business in a tax efficient way and a commercially balanced outcomes in the long run. So it is worth looking into that if you haven't done so already. Okay, moving on to the next stage of the transaction, due diligence and risk allocations. This is usually the stage where deals are either won or lost. So what does due diligence actually test? It looks at, well, the buyer will take charge of this process, and they tend to look at verification of the value first of all. So has the company overstated the valuation? Are there any risks or liabilities that haven't been disclosed yet? They will be looking out for any debts or issues in the business, both from a financial and legal and tax perspective. The reality is that no company is perfect when it comes to DD, but the risks that the buyer identifies can be addressed either in the contract in a way that protects the buyer, or occasionally it can have an impact on the headline price that's agreed, which may either be reduced or according to the risks that are found, or there may be minor points which can be addressed prior to completion by the founders. So the due diligence process typically has 4 key work streams, and those are financial, legal, tax, and operational. These are just the headline work streams. There may be some specific sectors or specific points that may be scrutinised in the due diligence process, depending on what your business does. But looking at these key points, first of all, so financial, as I mentioned previously, they're going to be looking at your statements from a financial perspective, revenue recognition, margins, working capital. Is everything in order, or are there any issues there? Legal, they will dig into the contracts, which you mentioned previously, looking out for things such as any change of control provisions, which could delay things or perhaps prevent contracts from being assigned. Are there any legal compliance, or issues with corporate records? Are there any consents or approvals which are required in order for the transaction to go ahead? To the extent that they identify any of these points, the sellers of a business will be given the opportunity to address them. And to the extent that they can't, it may have an impact on negotiations. Tax, this is usually where your tax advisors can help, and hopefully if you've planned in advance, no issues will crop up. But usually if there are any liabilities or unpaid taxes, that can have an impact on the transaction, and the buyer will, as part of their due diligence, be looking into any tax issues. And finally, operational. So this includes things like IT systems, HR processes, customer concentration analysis. Are you complying with the systems and processes that you have placed in the business? For example, if you are an IT business, and the business absolutely relies on the IT systems that are in place, do you have a disaster recovery plan in place in the event of a shutdown? The importance of being ready for these aspects of the due diligence process are really important, because the more organized you are, the easier and faster the process is going to be. And having a well-organized data room ready to present to the buyers can really help speed things up. It can also support the sellers with the disclosure process, because if you've got everything ready and everything's well organized, it can help speed it up and prevent the transaction from derailing in the event that something does crop up. There are also certain risk management tools that will be available to both parties in the documentation. The buyers will rely on warranties and indemnities to the extent that they come across any risks and issues during their due diligence process. As to what those warranties and indemnities cover and how long they last will be specific to the business and the transaction itself. The sellers will also have an opportunity to undergo a disclosure process. So this is effectively the safety net for sellers of business against any potential warranty claims. Everything you disclose as part of the process to the buyer will mean that you're protected in case anything crops up later down the line. In certain situations, we do also see warranty indemnity insurance that's taken out. It's not too common, but when it's worth doing, it is something that we see crop up, and there is obviously a cost implication there, and the parties do work together to negotiate and discuss what that looks like. Okay, and finally, moving on to the completion and integration process of the transaction. The completion and integration is still a very important part of the transaction, just as important as the other phases. There will be built into the documentation certain completion mechanics, which could include condition precedents, and these are items which the buyer will expect the sellers to deliver prior to or on completion. So it's important that you understand what those conditions precedents could look like. The common ones that we tend to see include obtaining consents from third parties, such as any finance or debt providers, any landlords, where there's leases over properties, to the extent that you're transferring over any employees. The process for that will need to be covered off, and any regulatory approvals as well, to the extent that you need to get consent. And sometimes the process for that can be quite lengthy. The buyer could include that as a condition precedent. There will also be some practical deliverables which your lawyers will help you with, and they include things like delivering share transfer forms in the event of a share sale, transitional services for particular services of your business, any HMRC requirements to the extent that it's relevant. And that brings us on to integration planning. So once you've completed, there will be an integration process, and the buyer will likely want to discuss how that looks like in advance. How are you going to align the culture, the systems, and the client relationships, particularly if the buyer is going to continue operating the business in the same way as prior to completion? We can also see a mechanic called the 100-day plan that's implemented. This is something that gets agreed in advance for completion and will set out any immediate priorities that need to be dealt with post-completion. Just a cautionary point that we've had at the bottom of the slide, in the event of a poor integration plan, we can see, we have seen situations where value of a business has been lost post-transaction. And that's not something that either a seller or buyer wants, particularly where a seller is linked to an earnout or deferred consideration as part of the structure of the transaction. Okay, so wrapping up today's session, the key takeaways. M&A is a growth strategy as much as it is an exit strategy, and we do recommend starting to look at your business and your exit plan now on day one, and putting a long-term plan in place to the extent that you can. Leaving it too late will make the process more difficult for both parties and could cause your transaction or deal to derail. So liaising with your legal advisors, your accountants, your third-party advisors, preparing and understanding what your structure could look like, what sort of exit you want, and how you can get ready from a due diligence and valuation perspective will really help. We do tend to see that the best deals tend to be those that are commercially sensible and not just legally clean. So it's worth understanding things such as what do your financial numbers actually look like and how does that link to valuation? Key things such as intellectual property, trademarks, or whatever the key sell point of your business is, how is that protected? Has it been documented, and is it all secure? To the extent that you have key contracts, making sure that your contracts are drafted from day one on an assignable basis to ensure they can be transferred without any consent issues later down the line. And as I mentioned, it's worth engaging early with your advisors and surrounding yourself with good advisors from day one to help you plan ahead. And that brings us to the end of today's session. On this slide, we do have a free download available for our startup manual. You can either scan the QR code and download it that way, or you can access it from our website. We do also have another webinar coming up, Winning the War for Talent, Effective Recruitment, Inclusive Hiring Strategies. This will be running on Thursday, the 11th of December at 11 a.m. And you can register using the link on this slide. If you are interested in becoming a LegalVision member, you can, of course, as I mentioned at the start of this session, sign up for a free consultation, and our team will gladly speak to you about our membership at LegalVision, which is available on an affordable monthly fee. As I mentioned at the start, to claim your complimentary consultation, please complete the survey at the end of the webinar, or you can contact us through our website.